Friday. So this week I wanted to talk about things not to do if you're actively looking to get pre-approved, already under contract, or thinking about buying a home anytime in the next, 6 months or so. So what we realize is that consumers just don't realize what they shouldn't do because they buy a home once every many years, so 7 or 10 years or whatever, and they just don't realize that the choices that they make really affect their ability to get through the mortgage process quickly, easily, efficiently, and all of those things. So I like to share some things just from doing this all day, every day. I pick up on how people just don't understand what they do and how they do it, and the choices they make with their finances and things affect their mortgage process. So number one, definitely do not change jobs if you can help it. This just causes kind of like a ruffle in the process. And definitely, if you have to change jobs, consult with your mortgage loan officer so that they can say, oh, well, yeah, that should be no big deal. We have plenty of time. Definitely don't change jobs yet because we have everything verified. So that would just set the time back or something like that. So do not quit your job. Don't change jobs if you can help it. And if you have to change jobs, I highly recommend you have to tell your loan officer if you're already, out making offers on houses, definitely mention that to your loan officer. And then don't become self-employed, because that could absolutely kill if you're already under contract and you decided to open your own business doing what you were already doing for an employer. Even though you're doing the same thing, that your income is not going to be calculated the same. So that's about jobs. And then don't open any new debt. So a lot of these things will seem like common sense to a lot of people, and then some people may just not think about it as they're going about their lives. They're not thinking to themselves, oh, this is going to affect my mortgage, or when I'm going to buy a house in a month or two here. So don't open any new debt. So there's two things with that. It's going to create an inquiry, which could sometimes drop your score, but also it's going to affect your debt ratio. So if you're already in process, if we actually do a credit monitoring up until closing. So if we see a new inquiry or new credit that's opened, we actually have to then go ask you what you've opened, and then we have to go and add that debt into your debt ratio. So if you're lucky, you'll still be able to buy. It could push your closing back because we have to send it back to underwriting. They have to re-review it, and your underwriting is busy, so your file's not the only file that underwriters are underwriting. So it could push your settlement back, and then worst case scenario, you may just not qualify anymore with a new debt. So don't do that. Furniture and appliances, do not go open any cards or anything at Home Depot or furniture stores and get your furniture prior to closing for the same reason. We have to account for all these things. And if we've already got you pre-approved or approved for that matter, it just really messes up the smoothness of your transaction. Highly recommend waiting till you settle. I 100% recommend waiting till you settle. Don't open cards for furniture or appliances, even though it's same as cash for 12 months or whatever. Just wait until you settle. Don't make any major purchases either. So if you're told you need $15,000 to close and you think you have extra money, you never know how the loan approval may shift because of things changed once you get into underwriting. So extra money is always helpful. We call that reserves, savings after you close. So I wouldn't go spending your money even though you might have more than what you are being told you need for settlement. So save your money until you close. And no excessive credit card use, just in case we have to update your credit. If you use your credit cards excessively, your minimum payments are going to go up, which is going to affect your debt ratio. So, be very, very aware of that. Try to do Nothing new or different while you're in this process, and for a significant time beforehand as well. Absolutely no late payments on anything on your credit, no late payments on your car, credit cards, anything, student loans. No large deposits. This is the number one thing people get frustrated with, is that we have to verify your money. And even though it's your money, we have to verify that it's legal money used towards a transaction. So number one, it has to be sourced, and number two, it has to be seasoned. Sourcing means we need to know where, if you made a large cash deposit into your account, we have to know where it came from. And if it's money that you've been holding for like 6 months in your safe in your house, and now it's just cash and you just put it in there, that's very hard to source. It's probably not going to be able to be used towards closing. So don't do that. So when your loan officer asks you if you have money, we're assuming it's money in your bank account already. And I'm very specific with all my questions to try to avoid future problems in the process. But big cash transactions, like we've had people sell cars, we've had people, I guess they save cash like in their house. All of this has to be documented. You can't use cash towards a mortgage, because unless we know where the cash is and can document where the cash is, it could possibly be not legal money, so we can't use it. So the sourcing of money is always a thing. It's in every purchase transaction, and people do get frustrated with it because they're like, it's my money. What does it matter? Why do you need to see my whole life? And what we're trying to document is that it's legal money. So the best thing to do is get your money in your account 3 to 4 months before you're actually going to buy. That's my best advice. And let it sit there, because once it's your money for over 60 days, we don't have to document where it came from. So if you're settling on June 1st, but you put all your money in your account in February, then we don't even need to see that huge deposit, and we don't have to ask about it. We don't have to have you explain it. We don't have to get your family's bank statement to show that it came from them or anything like that. So cash is a big one. We want to stay away from large deposits going into the bank account. And then try not to transfer your money all around either. We had this one file recently where they had 9 bank accounts and they were transferring money all around, and it became difficult to track, because we kept having to get more bank statements on each account to see where the initial source of the money was. And what it does is it creates a lot of frustration for the buyer, because they don't understand the reason why. I mean, I try to explain why we have to do it, but it doesn't change the fact that it's super frustrating to have to continuously give us more and more bank statements so that we can get to the initial source of the money. Because if a transfer came in 2 weeks before closing, and that's going to be used towards your down payment or your closing costs, we have to figure out how it got there. And if it was transferred from one account, but a week before that it was transferred from another account, we have to go all the way back to the original source of where the funds were and explain it and get all the bank statements, and people get really frustrated. So the best advice I can give with that is keep all your money in one account. Don't do a lot of transfers. Don't change bank accounts either, because we have to do the same thing. If you change bank accounts because you think that's like a nice clean start, it's not. We actually have to go back to the accounts you had before and document that you had the money in those accounts, and then that got transferred into the new account. So some people actually think it's a good idea to open a new bank account, but it's not, because we have to go back to the old accounts anyway. So it just creates more documentation for yourself. Do not co-sign for anyone. I hear this a lot. People think that because they co-signed and the other person is going to be making the payments, that it's not a big deal. Sometimes it's a really big deal. If we can't document that they have made the payments on the loan that you co-signed for a full 12 months from, say now back, or they were spotty in 1 or 2 months, then we have to include that debt in your debt ratio, and that could be a problem. So, co-signing is, you're 100% responsible for a debt that you co-signed, so we have to include it. So if you if your brother, your mother, your child needs you to co-sign and you're thinking about buying, or definitely don't do it while you're in the process, because we'll have to include that in your debt ratio. So these are things that can kill deals in the middle of them. So I wanted to bring that up. I talk to a lot of people every day, and it's just really clear that if you're not doing this every day like I do for my job, you don't think about how these types of things even affect your ability to get a mortgage, or it just more so it affects how smooth your process will go. So the less of these kinds of things that we have to deal with, the quicker and easier and smoother the mortgage process goes. So hope that helps. Always reach out to me anytime with questions on anything, and I'll be glad to answer them. And make it a great weekend, and I'll see you next time.